welcome. I'm Neha Bothra. You're watching our special interview series on money control. My guest today is a noted economist, widely respected for her views on finance and policy. She is a professor at Indira Gandhi's Institute of Development and Research. She was a member on the Prime Minister's Economic Advisory Council and is currently a member of the Monetary Policy Committee. Let me extend a very warm welcome to Dr. Ashima Goyal, who joins us on the show today. Thank you so much, Dr. Goyal, for taking time out and joining us this afternoon for this conversation. Very grateful for your time.
Sure. Nice to be with you.
Great, ma'am. I wanted to start by talking a bit about the GDP numbers that came in. The economy has actually grown 0.4%. It's a marginal growth, but it's encouraging because we are out of a technical recession. And even though there are forecasts indicating that there could be a steep contraction of about 8% for this current fiscal year, how do you see recovery panning out? And also, if you could talk a bit about the green shoots that we are seeing, how tangible are these? And how strong is the momentum as far as growth is concerned?
I think we have to remember that when the pandemic started, the forecasts we had, especially after the first quarter performance, were very dire, you know. And so, in that sense, we've seen quite a rapid turnaround. The economy's turned out to be much more resilient than expected. And getting a positive growth is really something very creditable. This is a positive growth over last year. The digital economies had a tremendous boost. And I think that suits India in two aspects because we have a lot of young people who are very comfortable with that. And it helps us to overcome the stretched infrastructure and overcrowding and congestion. So in that way, it's quite productive. GVA has actually grown at 1%. And given that expectations were about 5%, this is quite creditable. It's even above expectations. In general, it's much above expectations last summer. And in GVA terms, the contraction is minus 6.5, which is the value addition coming from industry. We've seen a turnaround in construction and financial services also. Construction is a very large employer, so we should see as employment rises, as incomes recover, people will be able to spend more. And although overall there's still a contraction in consumption, but you must remember that there was a steep fall in employment income, and then to I think income as a share of consumption as a share of GDP has held up quite creditably. So I think that there's a downside risk to the CSO figures. That GVA growth at least could be even better than that minus 6% for the year as a whole. And next year, of course, because of the base effect, we'll see really high rates of growth around in double digits. But that is something quite mechanical, actually we have to, we won't be catching up with our GDP level of 2019 until maybe the end of this year. So we are much below potential output. And here I think another of the, what we've seen in the latest figures is there's a turnaround in investment. Now, if you see for the economy since the whole of the last decade, one of the puzzles has been a slowdown in investment. That investment has not really picked up. So we are seeing some turnaround there. It could be because public spending is more in this sector, and that could bring in some crowding in of private investment. And in general, there are a lot of factors that are likely to help manufacturing, including the earlier tax cuts and so on, the PLI schemes, the diversification of value chains. So we should see manufacturing doing quite well. And then that means that potential output will also rise and the growth will be more sustainable.
With the economy now gaining momentum and we're seeing more encouraging signs from different sectors, you spoke about manufacturing, for instance, this will perhaps lead to better consumption and a recovery in overall demand. And thereby, there are concerns around inflation at this point. When you look at the high fuel cost, it only adds to the worries in most households about consumer inflation. What is your outlook for inflation, ma'am? And Because going through the minutes, it clearly did come across that the members were very concerned about the trajectory inflation would take here on. What are your views and how do you see this panning out?
So I think one of the issues last year has been this, we've had multiple, both demand and supply shocks. Demand crashed, but so did supply, you know. So we've had a lot of disruption in supply chains, not just in India, but also abroad. The supply chains are reestablished, the sort of commodity price shock we're seeing because of international, also similar sort of bottlenecks as they wear out. And then manufacturing has also saved costs over the last year, you know, with the substitution of digital and so on. That's why we've seen profit margins have been pretty good. So they have some capacity to absorb cost increase also. And I think in services, because people are going to be afraid of any contact, any area where there is contact, there'll be more competition, which will keep service inflation somewhat lower. Yeah. And the third issue is that some of the research I've done suggests that we've had inflation targeting now for more than 5 years, and this idea of 4% and between 4 and 6%, I think it has percolated. It enters into rental contracts, and that is what, as economists, we call anchoring inflation expectations. So because of that also, I think most forecasts see inflation coming down over the next year. By H2, it's expected to be around 4%. Now, these are all my personal views. I'm not giving any forecasts. The RBI has published, those are the MPC's official views. But I think that we could see, and the majority of analysts expect inflation to be down by about 4%. And that means that you're really anchored at the inflation target by H2 as the supply chain settle down.
So that is a big clarification coming from you in terms of what your views are around the subject, because most people at this point have been pretty concerned about the inflation trajectory in light of the high fuel cost, ma'am. There was also talk about looking into the tax structure for many of these items in the fuel basket. Do you think that this is going to add to the respite factor that you spoke about when you said that inflation could actually cool down and be within the threshold of 4%?
Yes, I think commodity prices, one is supply chain settling, that should bring down international pressures. We're seeing that there's an absolute change in the political economy of the oil market, because now supply response can be much faster, because of shale production in the US, with the substitution by green power sources and so on. So OPEC is aware of that. There's a limit beyond which they will not raise prices. And so these factors, as well as will moderate international commodity pressures. But in India, I think we saw a large rise in taxes when global commodity prices, fuel prices had fallen. And I think as the government's taxes recover with growth, they can afford to cut some of these taxes. So here there has to be coordination between the center and the states. Because if the center cuts but the states rise, then it's not going to raise taxes, it's not going to affect the consumer. And so ultimately, fuel should come in the GST, then you won't have this kind of problem.
So when it comes to monetary policy guidance on what direction it will take, how it's going to pan out, the use of overnight index swap rates is gaining a lot of popularity in terms of getting cues on how really the monetary policy direction will pan out. In the local context, in the present backdrop, how can this be applied to understand the monetary policy direction for the Indian economy?
Yeah, I think our money markets have developed. There's considerable depth now, and you get signals from all kinds of future rates. I find this enormous attention paid to MPC guidance. We are seeing that it's I think in India, I like to joke that we make everything into cricket. Whether it's the budget or growth forecasts or inflation, they're like numbers or COVID figures. There's so much excitement about everybody's projections, and so markets give a deeper kind of so many people's forecasts and projections are factored in. But I think the issue is that this has developed very much in financial markets, but how much is it affecting the consumer and aggregate demand? You know, so there, I don't think it's the market projections that are as important as the guidance given in the MPC or by the Reserve Bank, the forecasts, because those they down the reach industry, reach the consumer, reach the worker. And over the years, I think this 4% has entered the public perception.
RBI stands at crossroads, and there was something very interesting that RBI Governor Shaktikanta Das said. I'll quote him on this. He said that there's the difficult choice between trying dilemma of cliff effect. Should they unwind the balance sheet? Should they choose to do that? And then you have the moral hazard of ramp effect. If they should continue with the loose policy and monetary support that they are doing currently. So I clearly understand the dilemma, the tough balancing act, but which stance to your mind augurs well for the economy at this stage, given the various challenges that we are facing?
The idea that liquidity is enormously in surplus, and that is a problem. When you're working with this liquidity adjustment facility, any excess liquidity that is not used in the system is absorbed at the reverse repo. No? So you'll see even in this over the last year when liquidity was much in excess, money supply growth was moderate. It was around 12%. It wasn't very large. Actual increase in credit, what banks are lending, what is going out through the market,
We
CPs and
haven't
so
seen
on.
an uptick in the credit growth, though, for
Actually,
banks.
India, yes, and so India is really an outlier over the whole of the past decade. People say Indian firms are highly leveraged and highly indebted, and this is kind of. But if you see in the rest of the world, other emerging markets, there's BIS data, which shows our credit ratios are the lowest in the world. Our household debt, only our government debt is a little on the higher side compared to, say, East Asian countries. But compared to the Western economies, it's very, very low. So, I think our problem was really the reverse. That after the global financial crisis, we had over stimulus. And then in the decade of the 2010s, over tightening. Policy was too strict. You had absolute liquidity tightening. There was a decision to keep liquidity in deficit. Now, in an economy like India, you have large exogenous liquidity shocks whenever there are outflows or something. No? So, and then you had the ILFS collapse, and no lender of last resort function, no liquidity was provided. So when you talk to people on the ground, they would say that we've never seen the economy like this. There's absolutely no money. Everybody's hoarding money. Nobody's spending. You saw consumer spending collapse in that period because consumer credit just collapsed also. No, so what we need now, there is a distinction between durable liquidity and short-term or LAF liquidity. To keep durable liquidity, RBI earlier was keeping durable liquidity in deficit so that the LAF was putting liquidity in. But short-term liquidity is not a substitute for long-term. Now they are keeping durable liquidity slightly in excess, but it's being absorbed in the LAF. And the state in which the economy was, in order to overcome the past drought, as well as to overcome COVID and stimulate credit growth, you need durable liquidity to be in excess. So that is what Shaktikant Das has been saying, that the Reserve Bank will keep liquidity adequate. So when they started this TLTRO and so on, there's this panic, that okay, and rates start going up. That's a misunderstanding because they're not going back to the earlier system of deficit durable liquidity. Liquidity is going to be in surplus, durable liquidity. There'll be no shortage. But there's no reason to have, say, 7 trillion, whatever, rupees excess or 10 trillion. Yeah, because you're just absorbing it in the reverse repo. As much as there's reasonable surplus, there's no need to have, if rates fall much below the reverse repo, short-term rates, not long-term rates. then there can be, because that was a problem in a lot of NBFCs, before ILFS, because after demonetization, short rates were very low because banks were flush with liquidity. Same thing, they were putting it in the reverse repo, and yeah, and then a lot of mutual funds were also lending. A lot of people borrowed very short rates and lent long, and that built up risks. When the cycle reversed, it created huge risks for them. This is what I call mispricing, you know, or misallocation of funds. And those are the risks inherent in too much liquidity. When people are using short-term loans to make long, borrowing short and lending long. So you need a balance. And I think that is what is being done, that you're keeping durable liquidity in surplus, but not so much in surplus that short rates fall out of the band and it can lead to this kind of mispricing. But there is going to be no shortage of liquidity for, it's not going to move to the earlier deficit durable liquidity regime.
Hmm. Indeed, I see where you're coming from. RBI governor has categorically stated time and again that they will continue with the accommodative stance as long as required. But what really explains the nervousness in the bond market? Investors have been so jittery, and the jitters and tantrum that we saw in the bond market. How would you explain that, considering that the communication from RBI has been very clear that the stance will continue as long as required? So, where do you think this discomfort stems from?
I think it's experience. As academics, we know that there are a number of factors that affect bond yield. One is the U.S. Fed rate. One is expected inflation, expected growth, government borrowing. So the government borrowing announced in the budget was higher than expected, because everybody was saying the government is not spending; they won't need to borrow. Yeah. But it turned out they were spending quite. So they were borrowing more than expected. But you see now worldwide, what is happening is the central bank is supporting government borrowing because everybody agrees the government needs to spend more at this time, right? So the central bank has tremendous capacity to finance or to do OMOs, which so that the market need not worry that they have to absorb 12 trillion of market of government borrowing. The Reserve Bank has said that they are going to support this. Yeah. So that is one reason for fear, but that is unfounded. Yeah. The other is the US rate going up. But then, historically, although I think Governor Das has been saying that our 10-year bond rates are the lowest they've been in many years, that is true. But given that short rates are so low, the spread is still high. It's about 200 basis points, when historically the spread used to be 60 to 100. Yeah? So there's actually room for rates to fall. If you believe, and if you believe that inflation targeting, for example, is going to work, that inflation expectations are anchored. So there's this fear inflation will go up. And the other historical fear is that in the past, when we had the taper tantrum in 2013, US announced it was withdrawing QE, or 2018 when Fed rates were going up and fixed debt flows flowed out. I think it was mishandled by the central bank at that stage, because they raised domestic rates, even though our cycle needed rates to be softer. They tightened money supply. It doesn't work because foreign debt flows are only about 6% of our domestic market, and so the Reserve Bank has the firepower to prevent rates following the US. They do already. There's a large gap. Say some of this covers country risk premium or whatever risk premium is higher in emerging markets. But that is also perception. We know that a lot of these rating agencies, they're just based on per capita incomes rather than anything else. So there isn't that much risk in our economy, say compared to certain smaller or more indebted. Our external debt as well is not that high, given our savings are somewhat higher. And we've been very, very conservative over the past 10 years. So actually, we're coming from a very low leverage. So, okay, there was overstimulus after the global financial crisis led to large double deficits. But now deficits, at least the corporate debt, corporates have delevered, households also have very low debt. A lot of savings has gone up, precautionary savings. And this government has been very conservative in the past 10 years. Even now with the COVID crisis, people have been saying they're too conservative, they're not spending enough. And what they're spending now, they're very consciously putting it in investment, you know, which expands the supply side, increases potential output, and has a much higher multiplier, partly because the monetary policy can also support that, because they know it dampens inflation over the long run. No? So I think that given that we have had very cautious capital account convertibility, the Reserve Bank has room to moderate any rise in rates which comes from Fed rates rising. And Fed rate rise is not very large. It's gone from 0 to 1% or 1.6 or whatever. Yeah. Well, our gap is already, our rates are 6%. We have much higher rates here. So, and the final factor is that there is a quad effect in markets. There's a self-fulfilling fear. If the market believes or is afraid that rates are going to rise, then if they hold on to bonds, they lose money, right? Capital gains, they have capital losses. So nobody wants to buy bonds. And because nobody is buying bonds, the price will rise. Yeah, the demand, the supply is whatever, the demand supply imbalance. So here they must remember that the central bank has a big role to play in this, because they can support the market when markets are uncertain, and they have a huge potential power to come in as needed. So this self-fulfilling fear in markets, this uncertainty. I mean, markets are afraid inflation will rise, government borrowing will be so high, Fed rates are going up, so bond rates are bound to go up. Therefore, they are not buying, and therefore the yield goes up more. Yeah, but then the central bank is there to calm markets and to buy bonds. Yeah, and if inflation remains anchored, yeah, the Reserve Bank follows a different policy even under outflows. They've accumulated so much of reserves. They can sell those reserves, and that gives them more space. As it is reversing, the CRR has given them more space to do OMOs. So they sell reserves. Their balance sheet is, 2/3 full of US government securities, because of the reserves they hold are invested in US government securities. So we are taking in risky capital and providing safe capital to the US government to spend. So to the extent the risky capital coming in is less, if they allow some reserves to fall, they've accumulated 100 billion in the last year itself, right? Then they have that much more room to do OMOs, to buy our own government securities and keep rates low.
So the MPC in no way feels constrained by the bond market reactions.
The MPC, the actual liquidity management is in the Reserve Bank's hands. It's not something that the MPC itself deals with. Yeah. So we are concerned with transmission, I suppose. So to that extent, as I said, this very high spread between the short and the long-term rates is a concern. But the Reserve Bank has many tools. As I said, markets should feel reassured, because earlier, the last decade, there was not the intent. The perception was that markets should discover prices, and the Reserve Bank should not intervene. It's distorting market prices. But today, the perception is that you need to have coordination between monetary and fiscal policy, that you need to support government borrowing and spending in COVID times. Yeah, that markets should markets, they tend to have these self-fulfilling expectations. These sort of expectations should not be allowed to set in. So there are very different perceptions, and therefore markets should not think that what happened in the past. People are saying that, oh, whenever US yield curves went up, Indian rates went up. That was because of the policy decisions then. They need not be the same.
Hmm. Point taken. The government has outlined a new fiscal roadmap, and the government is now targeting 4.5% by 2026. What are the potential fallouts, risks, and costs that could come by way of this intent as far as the economy is concerned?
See, as I said again, here you should learn from the history of this government. They've been very conservative in the sense they've always announced a fiscal consolidation path and stuck to it, right? Or tried to stick to it. So I've looked at some of these figures, and it's very interesting. If you see in the 2000s, growth was very high. These days, internationally, everybody's talking about this R minus G, the primary surplus part plus the excess of growth over the interest rate paid on government debt allows debt to fall by itself, right? So that's why internationally they're saying R is very low, and so governments should just borrow. In India also, naturally, since we are in our growth rates are much higher than they are in the West. Yeah. And in the 2000s, we had very high growth rates and interest rates were low. And therefore, debt reduction was very rapid in that decade. Yeah. Even though the government was overspending, so there was fiscal pro-cyclicality. There was a primary deficit instead of a primary surplus. So that was going against bringing down debt rates. Yeah. But now in the 2010s, we had the opposite. We had very low growth, high R, right? The government was trying very hard to reduce deficits because they were concerned about rating agencies and so on, open economy, yeah, after the double deficits of the early 2010s. But you saw hardly any change in debt ratios because inherently this R minus G is working against you. So now I think we're moving towards more balance where interest rates will be somewhat lower, growth rates will be higher, and you work towards a primary surplus. The government is conservative in the sense that they want to um, bring down so counter-cyclical fiscal policy. And if that happens, then I think debt can come down. The reversal of the deficit is very feasible without, after the global financial crisis, too much stimulus led to overheating and so on. So I like to say that maybe the policy thinking and understanding has matured from over strictness to over stimulus, or rather there was over stimulus, then over strictness. Now there'll be sort of balanced policy.
There'll be a balance. Okay. Ma'am, coming to the monetary policy framework, there has been some talk about revising the inflation target. Some people feel that in light of the pandemic induced slowdown, perhaps the 4% can be relaxed to 5% as far as the inflation target is concerned. Now, of course, RBI and many other economists have cautioned about this particular move about tinkering or revising the inflation target. What are your personal views in this regard, ma'am? And what is the thinking as far as this inflation targeting revision of the 4% target is concerned?
The Reserve Bank is the agent. Yeah, even the government is the agent of the voter. Yeah, but they decide, then the voter has put them in power. So it's their prerogative to decide what the target is. The RBI has to, and the MPC has to implement it. So they will be taking the decision in March. But I think there's a lot of misunderstanding about inflation targeting. Actually, what we are following is flexible inflation targeting. Unfortunately, in the early years, when it was first implemented, it was followed too strictly in a sense. And if you see, actually, inflation has behaved very well in this period. It's been around 4 average. If you see the GDP deflator and so on, because even if CPI was high, WPI was low, and on average, it's been around 4%. And in an open economy, if your inflation is much higher than the rest of the world, your exchange rate has to depreciate and so on. So it's better to be anchored at about 4%. But that said, in an economy like India, where very often inflation is due to supply shocks, you need a little more leeway. And that can come either by extending the time period, allowing a longer period for inflation to come back, keeping the target at 4% instead of 3 quarters, allowing, say, 5 quarters before it comes back in exceptional circumstances, or giving some weightage to core inflation also. Because earlier, I think the choice of instrument was headline. And the thing with that is, because the way inflation targeting works in an economy like India is really through this awareness of the target, which is a long term 4%, but also your guidance and so on. For your guidance on the path of inflation, guidance is inherently difficult if it's about food prices which are volatile, no?
Yes.
So
But that's
if
80% of India's consumption basket if you
yeah,
take
so
food items
headline
into
inflation is important because this is what people understand. This is inflation for them. This is the inflation that matters. So you need, in my own view, there should be a guidance given for both headline as well as core inflation. The target could be a weight, or both could be there as targets with slightly higher target for headline, which is more volatile compared to core. Yeah, because core is where aggregate demand can affect core. But headline is largely supply shocks, which is not in the scope. That is more what the government does that matters, the taxes, the MSPs, so on. And general improvement, this cost of doing business, as it goes down, you will see, you should see, I think the economy, all these bottlenecks and infrastructure constraints generally raise costs for everyone, congestion. As all this improves costs of business, costs go down. That affects inflation. So just to summarize, my view is that either that a 4% is all right, plus minus 2%, but maybe you can have a longer period for it to kick in, or you can have some weightage for core inflation.
Okay. Also, speaking a bit about the state of the banking sector overall, if you could share your views as an economist in this area, loans to the tune of about 9 lakh crore are under moratorium, and it's pretty opaque. Bankers fear that a significant part of it could slip potentially. These could be large. This is the concern. Do you think that the twin balance sheet problem has actually deepened, considering that we already had a very big pile of NPAs? Before this problem came into consideration as well. So, would you say that the twin balance sheet problem has actually deepened?
So here again, I think there's a big gap between perceptions and reality. Because we started by talking about how, the recovery of the economy has been a surprise. Nobody expected it. And one reason nobody expected things to be much worse was they said that the economy is already slowing, banks have huge NPAs, they will get burdened more with all this COVID, things will just, but we are seeing the results declared by banks. Many of them have raised equity cushions. They're finding that even restructuring, moratorium, a lot of people are repaying.
But there's standstill on
No,
recognition of.
but a lot of banks are declaring what are called pro forma NPAs, which is
Hmm.
what would be the NPAs if there was no standstill. So even with that, they're seeing it's much less than expected. Now, if the economy recovers faster and people can repay, so then to that extent, the NPAs will be less. No, as a direct result
RBI
of
estimates that it could go up to 13.5% by September. You feel it
that's
could
not an
be.
estimate. That's not an estimate. That's a scenario in the stress tests under certain assumptions made in October. That time COVID curve hadn't flattened and etc. So under the growth rates forecast at that time, which were much worse than they are currently. So that scenario is unlikely to be realized. Yeah, but also the other thing is that we didn't start from such a bad place. Because 10 years, as I said, the last 10 years, you had very slow credit growth after the exuberance of the infrastructure lending, over lending, the boom. We've had absolute tightening. We've had so much banking reform, AQR, IBC. So many banks have actually recovered loans through the IBC, you know, and actually their gross NPAs are high because of delays, but net NPAs were 3-4%. No, they're provisioned for those loans, and as they recover from the IBC, this will add to their bottom lines. So banks are actually in a good place. They had overcome the last boom and were ready to lend again when COVID happened. And because of the worries, and the other thing is there's been a change, a reform. There's generally an acceptance that you need to do risk-based lending. So you are covering possible losses in the interest you charge and so on. So it's unlikely to hit your balance sheet that much. Yeah. And also, you're not lending anymore to corporates who are building infrastructure. You're not lending 2,000 crores and 4,000 crores. You are lending small people, small amounts. So there's automatic diversification there. Diversification is the best way to bring down risk. Even if three people collapse, it'll just be 1% of your loans, not 50%. So your exposure limits are much lower. So all this reform has put Indian banking in a much better place.
My last question to you, that there are multiple moving parts at this point, and we do understand that there's not one, but several factors that one needs to watch out for. But to your mind, what is the one biggest risk that could perhaps threaten macroeconomic stability that you will be closely watching out for?
I think it is uncertainty related to COVID itself. Now we're seeing some resurgence, and the vaccination drive should be accelerated, but our population is so large, it will take a lot of time. I think they should follow a sort of cluster approach. There are a few places where it's really flaring up. So focus the vaccination there. Because the fear is that these mutations, where there's a lot of infection, mutations can occur, which can make things difficult. Overall, I'm quite, I think the economy is diversified a lot. It's a lot of reforms have been going on in the financial sector. It's also become more robust. Even though bank lending is now picked up, lending through corporate bonds, other private placement, commercial papers, equity funds from abroad, raising money. All that is happening. Quite a lot of activity, and even in other areas, agriculture. It's sad. These current agitations of political economy issues is also another big risk, because I think that is an issue. People, it's very sad. I think as India, we've been underperforming compared to our potential. And when you have the opportunity, we are focusing on the negatives and destroying that opportunity, or hurting that opportunity. That's very sad.
What are the structural constraints? In effect, you're talking about reforms that have been put in place but haven't been implemented because of various reasons. So, what do you think are some structural constraints that the economy will have to grapple with, and which could perhaps limit the benefits we could see from the government's thrust on infrastructure and privatization to unlock potential as far as the country's growth potential is concerned?
See, my view on structural reforms is slightly different. I think the last decade we had slow growth because there was too much focus on structural reforms and a total neglect of counter-cyclical. You cannot, the low-hanging fruit is already picked. The reforms that remain, such as labor, land, agriculture, they involve large populations who are negatively affected, at least in the short run, and they're going to protest. In a democracy, you have really loud protests. So rather than focus on, there's some areas where you can do it and you need to do it. Reforms need to be done, but I like to use the term reform by stealth. And in India, where you have a federal structure, you can do it by setting up competition among states. You can do it quietly. Don't announce big schemes which lead to resistance. Yeah. And so I think we've and focus on where it's easy to, because technology, I think a lot of these e-governance initiatives, like putting land records on an e-platform so that you can have better buying and selling and collateralization, all that is highly feasible using technology. which gives us an opportunity. I think the reason we did well in software and so on was it allowed us to sidestep the infrastructure bottleneck. So use technology, use our youth, use their digital skills to bypass some of these constraints intelligently. Don't push where you'll encounter huge resistance. Bring those, like there's a saying, last man standing. Once some states are reforming, the ones who are not will get left behind and they'll realize, they'll learn, they'll want to do also. So I think that way, the structural constraints, we have ways to sidestep them intelligently if we want to do it. So they're not such a binding constraint anymore.
Thank you so much, Dr. Goyal, for joining us and sharing your insights. Thank you so much. That was Dr. Ashima Goyal speaking with us and taking us through a wide range of issues affecting macroeconomic stability at this juncture. She highlighted the RBI will continue to maintain the accommodative stance as long as required. This is all we have time for on this edition. Time to wrap it up, but do stay tuned to our series. We'll continue to bring you top voices from the areas of finance, markets, and economy. Thank you for watching and goodbye.